think they are ETFs 2.0. Vaults are just the next step in that. I think they are a more efficient expression of asset management IP than even ETFs, which is saying something. So I think long term, you're talking about a 20 or $30 trillion industry.
The ability for investors to customize their strategies will go up. The cost of forming a vault and raising capital goes down. It's like laughably the case. It's a tremendously new and exciting paradigm that I think is going to explode.
They're basically a way for you to encapsulate DeFi strategies that in theory you could do on your own. And now we're at the stage when you're starting to actually see the institutionalization of this thing that has been growing now for years. The level of control that a user has in a vault is very different from the level of control that an investor or an LP has in a fund. There's one difficult question that the industry will have to grapple through though, which is
Hey everyone, welcome back to Inflection Point, the podcast for the institutional audience. With me as always is my co-contributors, Michael, Matt, and David. This episode, I think we're going to be talking about vaults. It's something we've been putting off for some time and really excited to talk about. But before we dive in, I want to note that none of the information discussed constitutes investment advice or any offer, recommendation, or solicitation by Blockworks, Galaxy, Bitwise, or Anchorage, or any of their affiliates to buy or sell any securities. Okay, with that, let's kick into it. Glad to have you, Matt and Michael, back on the pod after a little hiatus last week. How are you guys feeling?
Feeling good. Get ready to rip. Feeling great.
Yeah, it's great to be here. Great to connect with you guys. And for sure, this one has been in the development stage for a while. So really excited for it.
Well, Bitwise is leading, I think. I'm just going to kick it off. Bitwise is very much leading, I think, in the institutional space in vaults right now. You guys are forward thinking. I attribute that almost entirely to Matt, the great CIO of Bitwise. But yeah, I mean, Matt, give me your take on vaults here and why Bitwise is so focused on it.
Well, first of all, I should say that it's not me. I appreciate the kind words. There's an incredible team working on the Vault solution. Look, vaults are really interesting from two perspectives, and then there's this muddy middle where there's a question. From a short-term perspective, there is really significant demand for vaults from sort of crypto native, crypto foundations, people seeking yield. And our view at Bitwise is that as vaults mature and deal with this more sort of institutional crypto audience, there's a place for more established, regulated crypto managers. So that's thesis one. The other big thesis on vaults, which I think is true, and I've said this before, is that I think they are ETFs 2.0. I think that asset management has been a 400-year journey of making it more efficient for investors to gain exposure to IP investing in the markets. And it's improved over time from closed-end funds to open-end funds to ETFs. Vaults are just the next step in that. I think they are a more efficient expression of asset management IP than even ETFs, which is saying something. So I think long-term, you're talking about a 20 or $30 trillion industry. The really interesting questions in vaults from my perspective is how we get short-term from the, a few $100 billion opportunity that's, I think, transparent to all of us, to long-term, to the $30 trillion opportunity. That's where a lot of the questions lie. But yeah, that's why Bitwise is so excited. We clearly see the immediate demand. We clearly see the long-term transition. And we're excited to play a role in all of those processes.
That's awesome. Does anybody want to start with a definition of vaults? Because I feel like this is a word that sometimes gets...
Take it away, David. You signed up for it.
Oh, me? I was expecting Michael to get this.
I can hit it.
I can start. Okay. So, I mean, maybe even before that, take a step back. the reason vaults are basically a container, and they're basically a way for you to encapsulate DeFi strategies that in theory you could do on your own. If you were like touching the bare metal of some of these base DeFi protocols, you could do a lot of these strategies on their own. But the cool thing about vaults is that they productize these DeFi primitives into something that can be encapsulated and utilized by an institution like Bitwise. There is something cool here about us moving from researching, exploring new primitives into productizing things that already have product market fit, which is basically on-chain credit market. So that's the first thing I would say about vaults and why I think they're very exciting. Even beyond the product itself, it shows that we're going beyond this exploration phase within DeFi. But the way you think about vaults is basically a container. Vaults kind of existed for a while in maybe a preliminary form. Matt will remember this. We wrote a DeFi primer, in 2022, and we were talking about all the big traditional finance verticals that could be put into a smart contract. And one of them was asset management. We had that category there, very explicitly citing Earn Finance. So Earn Finance was one of the earlier DeFi protocols created by this guy Andre Cronje, like one of the DeFi genius. He just got too tired, probably, of having to look for the best yield opportunities. So he started to automate some of that. It started very simple, started to get more sophisticated. I think at some point it started to go multi-chain, started to go beyond Ethereum. But that's probably where DeFi vaults have kind of started. I think it was probably in 2024, maybe, that the Vault Curator model kind of started. And we started to see things like Morpho, and this thing started to evolve a little more. And now we're at the stage when you're starting to actually see the institutionalization of this thing that has been growing now for 4 years and has been breeding for a while. But the way to think about vaults for me is kind of this container that in theory can contain many different strategies. To Matt's point, today it's very focused on yield strategies. On one end, you have a lot of stable coins that are chasing yield. For some reason, it makes sense for these stable coins not to go on and off fiat, for them to stay on chain. And it's natural for these things to search for a yield. On the other side, you have on-chain borrowers. This is mostly folks who want to go levered long, ETH or BTC in any way, shape, or form. So you have these credit markets that are basically putting these two parts of the market together. And Vaults is a way to do that in a way that you have like a risk curator role that is parameterizing like all the risk factors. There's a compliance layer. So like all these things. So it's a way to make an institutional product out of something that has existed in DeFi for a while. But Mike, complete what I'm missing here.
Yeah, no, I think that was excellent, David. The way I think about vaults are, well, first, just to be very clear about, because you said container, and that is accurate. But like, if you think about it, a vault is a smart contract. And it is a smart contract, which just means it's a computer program. I'm going real basic here, just so it's very clear. It is a computer program that lives autonomously on a blockchain. And it's a computer program that lives autonomously on a blockchain that you can program to do n number of things, right? And it is being used today in such an exciting way because it is being used as a programmable fund. So I used to talk about how smart contracts, before I knew anything about DeFi, like 10 years ago, I think I've mentioned this. I think I mentioned this on the pod in history in the past. When I was a lawyer and when I was in law school, I got really into DeFi because I was studying contract law. And I thought, wow, there's something called smart contracts. I need to know what that is, right? And then, of course, I learned about smart contracts and I learned that they have almost nothing to do with contracts. But I'm now revising that thesis a little bit, okay? Because they actually look a lot more like legal contracts in this context than you would think. So what is a fund? A fund is a series of legal contracts, right? When you invest into a fund, you sign a bunch of paper, right? That paper, one of which is contributing assets into something. What is that thing you're contributing to? It is a limited partnership. What is a limited partnership? It is a corporation of some sort under corporate law. These are all contracts, right? But they're all paper, right? To police, to oversee that fund, you need lawyers to look at that paper and see if you are complying with the terms of the fund. It's very slow. It's not dynamic. And no matter how dynamic you try to make it, at the end of the day, you got to get a lawyer to interpret all of that dynamism. When in the context of crypto, a smart contract actually can serve as that fund structure, but it's now a computer program. It's now programmable. And so you can now deposit money instead of into a regular fund, into a smart fund. Maybe we should rebrand Vaults smart funds, right? A smart fund that it already has encoded in it a strategy, and you will get not daily updates, not weekly updates, not quarterly updates. You can get real-time updates on the performance of that fund, and you can have real-time transparency. And here's the best part. The best part is it can be non-custodial. So one of the biggest barriers to funds today and to the entire hedge fund and asset management industry is that the government and the law treats it, in fairness, very appropriately treats it as something that is a high risk to investors because they're parting ways with their money. And so it's heavily regulated, right? You have to be a registered investment advisor. You have to comply with a ton of different rules because you, as the fund manager, control the capital. We are entering a new paradigm with vaults in which you can deposit funds into a vault and the vault manager doesn't have custody over those funds. It's a tremendously new and exciting paradigm that I think is going to explode. So when Matt says how do we get it to a $30 trillion industry? I think plays a big part of that.
Yeah, that's exactly right. That's exactly what I meant, where it's sort of distilled asset management, right? With all the gunk that you had to do as an asset manager, all the lawyers, all the paperwork, all the custody, all of that is removed. Now, there's still a lot of things that exist. It still needs to be a high quality strategy. You still need to diligence that strategy. You still need to look at credit risk. You need to look at liquidity risk. You need to look at duration risk. But what's left at the vault layer is what most people think of as asset management. It's just when you work in asset management, you know that the actual portfolio management and risk management is like this tiny little sliver on top of this really thick cake that's expensive and slow. And what I love about vaults is it just gives you like the frosting or whatever. It just gives you what
Yep.
you want, and you remove all of this sclerotic mess. So yeah, I loved how you guys described it.
Matt, can I ask you just real quick, Matt, follow up on that? Are you seeing any innovation in this right now and how it's working, right? Like, because once you upgrade a product in finance from let's just call web 2 to web 3, or you're updating it from a sort of an old school way of doing things to a programmable or computerized way of doing things, it unlocks a tremendous amount of innovation. Are you seeing any of that right now, Matt?
Well, certainly there's a lot of innovation, but I mean, I'll raise a few things, and maybe you can direct me where you want to go. But we are seeing a breaking down, and I think this will increase between on-chain and off-chain yields, driven by this desire for vaults to express that and to be able to weigh the relative risk of those two things. So it's actually driving the convergence, from my perspective. That, like, if you want to think of the catalysts that are bringing us on chain, the real world on chain, vaults, like exploring that, I think is a real innovation. I think you're going to see innovations in terms of transparency, in terms of insurance, in terms of diligence on these vaults as well. Um, but that cross comparison of on-chain and off-chain yields and opportunities and risks, I think, is one of the innovations that vaults are really driving right now.
The other thing that is pretty important, I think, and you don't see this in every single vault. And again, vaults are different across each other's. And there's the vault curator layer, there's the vault infrastructure layer. Maybe we need to define these things a little more. But one interesting thing in this, let's say, on-chain finance or on-chain asset management, I've been calling it on-chain robo-advisor world, is that the user has more input than it would in a traditional asset management structure.
Yes,
So
yes.
it depends a lot, again, on the type of vault. But for truly decentralized vaults, the user can have an input. There's kind of a quote unquote governance mechanism that the user can override certain things that for whatever reason doesn't make sense.
Yes.
On the transparency side, you can think a lot of these vault infrastructure providers as basically NAV calculators. They're calculating this NAV. And to the extent that this is done entirely on chain, and at least to some protocols, I think that's true, right? Morpho, for example, you have 100% transparency on how this quote unquote NAV is calculated, on how everything is happening under the hood. And I think this speaks a little bit to the transparency benefits that Matt is alluding to.
I love those. Let me just build on those and make some tie to the traditional asset management industry, because that may resonate with our audience. Some of the things you're pointing out, David, are things we've seen the traditional industry take a step towards. I come from an ETF background. Used to be that no active management strategies disclose their daily holdings. ETFs blew that up. Now the best active managers in the world are showing you every day what they hold. It hasn't harmed their returns. It has improved transparency. It's made diligence by the end investor better. This takes that concept and like puts it on infinite steroids. So in terms of empowering users to have that transparency and view to make the right evaluation, it's a huge innovation. The other one towards what you were talking about, Mike, wealthy individuals are able to customize their portfolios through SMAs in traditional asset management if they meet certain thresholds. If they have 10 million, if they have 15 million, if you have $100 million, Goldman Sachs will build a portfolio that does whatever you want. But if you're a traditional investor, good luck with that level of customization. And one thing these vaults do, and David was talking about sort of governance style input, is that they drive that service down, right? They're so much more lightweight that it drives that down. And I think that's also really powerful for
yeah. Oh, yeah. The cost of forming a vault and raising capital goes down. It's like laughably the case, right? So, I was talking with a couple of people a couple months ago, and one of them was the founder of Compound, and Compound, was an original sort of borrow lend protocol on Ethereum, one of the OG, right? And I always knew this to be the case, but it really clicked when someone said Compound would make $100 million a year, zero expenses, like zero. They didn't. It was a smart contract program. There was zero expenses, right? I mean, that is incredible. Now, obviously, with vaults, there might be some slightly more friction, especially in permission vaults, and that institutions are going to be attracted to. And I do think we should talk about the drift hack. I think this is sort of important and adjacent. But the cost will be driven so down. The ability for investors to customize their strategies will go up, not through a lawyer, through a program that they can tune. It is so exciting. And the only limitation, there's a couple limitations, obviously, but the one big one is we just need more real world assets on chain, right? That's what we need, right? The technology is there right now. It's the assets that aren't there.
I've been listening to you guys, and vaults are definitely revolutionary. From one side of it, I know we've compared it to asset management. We've used the word fund many times. We've used the word curator, which is basically asset managers, and then you risk curator, which is part of the risk regulations of it, the internal regulations.
By the way, Mark, we should define what a curator means. I think some people in our audience might not be that clear about what that concept is. But keep going. Sorry, Mark.
No, yeah, for sure. I mean, basically an asset manager, but I'm saying like we're
Yeah.
using all of these terms, and then this is a question I brought up maybe a few episodes ago. Is this a security? Are vaults a security? And just we're kind of skirting the regulations right now. The regulations aren't there, and then I mean, does it really matter? Because if they are, because to Matt's point, we know it's like maybe what, tens of billions of dollars industry now, 20 billion, and he put the goal as tens of trillions of dollars, right? And I mean, the way that we're going to go there is not through retail, it's through institutionals, and like you mentioned, there's not enough real world assets on chain. And so is it where are we going to see the growth mostly from permissioned KYC institutional vaults, where you will have all of these benefits of transparency and everything that you said, but most of DeFi, when I say DeFi, most of the crypto natives that exist now will essentially not be a part of it unless they choose to conform out of their cyberpunk values.
Well, can I take the security point first?
Yes, that was for you, Michael.
Yeah. So they can be a security, right? I'm gonna try, and guys, on this pod, I'm gonna try to not give the obnoxious lawyerly answers. I'm gonna try to give it to you guys straight, right? Because most lawyers would say, well, they could be, maybe they are, maybe they're not, depending on these different factors. And you left being like, I don't know what's up or down. Quite simply, if the vault has tokenized securities in it, it's obviously a security, right? The question is then, if it doesn't have tokenized securities in it, does the process by which you deploying your non-security assets into a vault and being curated by a third-party curator, does that elevate it to something that looks more like a registered investment advisor activity and therefore regulated under the securities laws? Not to say that it is a security, but that it should be regulated as a security. And the answer is, in my mind, is that curation does not, in most cases, there's many flavors to curation. I want to be nuanced here, but in the way we're seeing it predominate today, because of the non-custodial aspect of this, it removes a big reason for it to be registered as an RIA, right? This is not to say that RIA products will not predominate because investors prefer registered investment advisors to be curators, but it's just to say that right now, as it stands today, companies like Gauntlet, I don't think need to be RIAs, and I don't think they need to be considered as such.
Yeah, I think this also speaks a little bit to our ability of coming up with really terrible names for primitives. Vaults is one of them, actually, right?
Agreed. Agreed.
You just throw things there and just leave them there. Raise is another, but we are very good at coming up with these bad terminologies.
Almost an undefeated record on
The
that.
smart contract is the only one that's good. It's the only one. Everything else is terrible. I totally agree with that.
A very good one. I'll give you that. But I think to Michael's point, it's very important to keep in mind, and that's why I think sometimes you got to be careful with the asset management label here, because you have in traditional finance these, let's say, legal enforcements, and a lot of what's going on in DeFi is coming from cryptographic enforcements. And a lot of this activity, and we all spoke a little bit about this, is it's the level of control that a user has in a vault is very different from the level of control that an investor or an LP has in a fund. So, of course, our industry has an issue with decentralization theater. And at some point, you're going to have to mark a line on the sand and say what is one thing and what is another thing. But at least today, and again, definitely not a lawyer, but it does feel that the activity is extremely different from what we see in a traditional fund. And I think this is important to keep in mind.
I would absolutely agree with that, but I would add that the risk for the industry, the risk to vaults, is that that means there's the ability for good and bad actors to participate unfettered in this space. And to the extent that the industry can fill that, what you're saying is true, but fill it with some version of like almost self-regulatory enforcement of good actors, will be to the behoovement of the growth of vaults long term. Right. I do think one of the risks is that it does have this openness. There, as you said, good legal reasons to believe that that is true, but that creates brand and reputational risk that I think is meaningful in the space. And I hope the industry steps up on standards around that.
I don't think they will. This is why I believe it will tend towards the permissioned vaults being the dominant factor. Because, I mean, okay, Michael brought up the drift hack, right? Like the contagion between all of these different strategies is so vast, and you want some kind of accountability through legal recourse. You want professional advisors. You want professional risk curators, and and I'm talking about for institutions. I mean, obviously retail wants it too, but retail is going to punt their funds into any vault with a high enough APY. So I don't think it matters there. And then, yeah, Matt, go ahead.
No, I think you're generally right. I think
Okay.
over time, what we found in the growth of DeFi, where there's a similar example here, is that brand and reputation risk that builds over time is part of the solution to that. So I don't think you're wrong, but I do think that that is part of the solution that we'll see in the space.
Yeah, like the gauntlets and the other risk creators, they will becoming those institutional players given the years of experience. Yeah.
Yeah, and you have a Lindy element and a brand value at stake that constrains negative action.
Hey all, Blockworks co-founder Michael Ippolito here. Quick break to talk about something we've just launched, Blockworks Investor Relations. As the market shifts toward institutional capital, investors want more transparency, more standardization, and a higher level of professionalism. But the traditional IR model is slow, manual, and not built for how crypto works. If you're building on-chain, your data is already live, your business is already transparent. The challenge is turning that into a clear, credible story for investors. That's exactly what we're solving with Blockworks IR. It's a single platform that brings together real-time analytics, branded investor portals, and hands-on advisory support so you can communicate what matters. If you're an on-chain business looking to level up your investor strategy, check out Blockworks Investor Relations at blockworks.com/investor-relations. All right, back to the episode.
Is this a good time to define what a curator is and maybe differentiating the curator from the vault infra provider and maybe any other layers that we might find relevant here?
Yeah. Take it away.
I could take it. I could take it real quick, David, if you want.
Go for it.
So in the beginning, there was Aave, and there was Compound, and these are borrow lend protocols where you deposit collateral in, you receive a receipt token of your collateral in there, and then there is a fixed formula for pricing that coin in the protocol, a fixed formula for lending it out, and you get interest on this by virtue of a fixed formula that is hard coded in the protocol. And these were very, very successful. They still are very, very successful. However, by virtue of it being a permissionless, immutable system on chain, there's only so much dynamism you can encode into this fixed borrow lend algorithm to make it competitive with an alternative product in which it is actively managed by someone else. And that active management came about with Morpho, in which Morpho created vaults. They didn't create vaults, but what they did is they took the concept of vaults and they layered a custom risk manager on top of it that was able to dynamically adjust the risk parameters as they saw fit based on a proprietary risk engine that they work hard to build in order to determine at what rates they should be lending out third-party non-custodial capital that is deposited into a Morpho vault. And just one other thing, just so our listeners are very smart on this, you can analogize this to DEXs, what you're seeing right now with DEXs. So in the beginning, you had Uniswap, and Uniswap was defined as X times Y equals K. What does that mean? That is a fixed formula in the original Uniswap pool. And what that means is that if you deposit assets into a pool, you deposit a pair of assets into a pool, ETH and USDC, and there's a fixed formula by which you price those assets. So if I swap USDC in, I get a fixed amount out. Okay. Now, there was a lot of innovation in these fixed formulas on DEXs, but they were never as good as order books, right? They could never price things as dynamically as order books, but you could not have order books on chain because order books on chain, they suffer from a host of different problems. And so for much of the history of DEXs, you had these fixed formulas that were really, really good at pricing assets, just a little less good at pricing assets as order books. And the order books existed off-chain at Binance and Coinbase and Kraken. And the on-chain DEXs were really good for DeFi natives, for composability, and for illiquid, I call it illiquid assets or small cap assets. They're actually superior at pricing small cap assets than order books because market makers are what power order books, and market makers aren't going to hold illiquid small cap assets. So what came about over the last year was the invention of the prop AMM. And the prop AMM it was originated on Solana, but it moved on to Base. Now there's talk that they might even be on Ethereum. And these are very analogous to curators in the sense that you have a vault of capital and you have a market maker that instead of market making defined by a fixed curve set on chain, it is defined by a dynamic curve that is adjusted in real time by the market maker. So you're seeing these parallel innovations happen in real time with curation for the borrow lend and for the asset management type strategies, and prop AMMs for high frequency market making in DeFi right now.
Yeah, this is a great description, and I think it talks a little bit about this hierarchy of services within DeFi. And at the very bottom comes liquidity. Everybody needs liquidity. Even if you are Aave, you need a liquidity layer because you need a place to execute your liquidations, for example. So liquidity sits at the bottom, and then you have the lending protocols. And now vaults are kind of coming on top or integrated with these protocols and the borrow lend activity. The one thing perhaps is also worth highlighting is that when you think about the vaults ecosystem, there's the curator layer, right? And these are kind of quote unquote risk managers. And there's companies like Gauntlet, there's companies like Stakehouse, now companies like Bitwise and some others. These folks are basically spend a lot of their time kind of defining the risk parameters, kind of building trust with their, let's say, clients or investors. There's also the part of the node of the vault infrastructure provider. So basically, this is where Morpho fits in. This is where a company like Veda Labs would fit in. Maybe Morpho and Veda are a little different. Maybe, I don't know, Veda is more multi-chain. Some folks would say Morpho are more decentralized, but these guys are also basically building the infra that a lot of the curators will use. Some of the curators, they own more of the stack. So like Gauntlet has its own vault infrastructure system. So they're folks that go to a more verticalized model, but it's important to keep these two roles in mind. And I would add that there's now a third layer emerging, which is the integration layer. That's where Anchorage fits, by the way. So the integration layer are folks who are giving access to some of these curators, especially within a regulatory perimeter, right? So like Anchorage started to provide access to select Morpho vaults to our clients without them having to leave their assets off qualified custody. So there's a bunch of benefits and kind of regulatory comfort with doing those kinds of things. I would argue that there's now an emerging kind of integration layer. So I think hopefully that helps kind of put into context. What are the layers? Who's at play?
Great point.
That's exactly right. I love that. And mirrors what exists in the traditional world as well, where you have similar layers, not quite the same, but similar layers with similar roles, from people who aggregate clients and give them exposure to certain things, to tools and operators, to asset managers as well. So it's really beautiful to see the important parts of that ecosystem being recreated in the Vault side, while a lot of the Drek is not being recreated because it's not necessary. Right? That's the beauty of this innovation process.
On the TradFi side, David mentioned the liquidity layer, the lending layer, the vaults on top of that. Do we see a world where vaults, right now it's primarily lending and yield strategies. Do we see a world where it branches out from that, where it becomes more akin to maybe just ETFs? And also, if not, or whether or not that does take that path, do we see ETFs being the layer on top of that, where an ETF could be an actively managed ETF that holds multiple vault securities or something of the sorts?
I mean, it's a beautiful. I love dwelling in. Absolutely, eventually, I think is the answer. We're look, from 30,000 foot view. We're moving to a world of financial super apps, where the lines between crypto and tokenized securities and traditional securities and other offerings are all blurred, and they're all effectively held in the same place. Right, Paul Atkins has said that is the world that he wants. He wants to see the emergence of these super apps. He wants all traditional assets to move on chain. That is the world, I think, where we are going to be at some point in the next 5 to 10 years. And so the question becomes, in that world, what is an asset manager? And I think the answer to that is Vault. So that's a sort of roundabout way of saying that I think, of course, eventually it could be multiple different types of assets. We're sort of, as I mentioned, already seeing that to some degree, with considerations by Vaults expanding beyond on-chain strategies to tokenize real-world assets, right? That is like the first baby step. And then from there, could it be other assets as well? Of course, I'd bring another analogy from ETF land. ETFs were only equities, and bonds were quote unquote impossible until they launched. And then commodities were impossible until that launched. And then hedge fund strategies were impossible until that launched. And then leverage, and then private loans, etc. This is just the same story repeated. We're starting on yield because that's where the proximate demand is, right? From the stable coins, search. It's urgent, and it needs to stay on chain. It's urgent. So that's where it's starting. But I'd be interested what the guys think. I don't see in a super app world how it doesn't expand beyond that to include other assets.
It 100% should expand, but I think it's also important to keep in mind how early we are. Today, most vaults are very short-term duration and very low yield. Like we barely, I don't think we even have a fixed yield market. We cannot go much further than a few days kind of duration. So we're still very early. And I'm sure we're going to see a lot of advancements, especially if you bring in maybe an AI component. I would be interested in seeing how like AI could be running some of those risk strategies, but those things are probably further down the future. We have a few interesting, I wouldn't call them vaults, but we have a few interesting structured finance products that work in crypto very well. Athena is a great example. And that's basically a tokenized basis trade. So I think we're going to see more and more of these strategies get incorporated into vaults, but still very early. And that's why we're a few $1 billion big, right? That's why we're not at the hundreds of billions. That's not why we're at the trillions and all these big numbers. I think the market will also need a lot more maturity. Not only we need more real world assets on chain, but we also need more sophisticated activity in the market. Again, today, most of the borrowing activity are folks over collateralizing their ETH and getting more dollars to buy more ETH, then do that loop a few times and get a levered ETH position or BTC, whatever the underlying liquid crypto asset is. So that's where the market is today. And as Matt said, now maybe we're moving a little bit more towards RWAs, and I think things will move from there. But those things take time, which is natural. And I would say it's even good, right? We want to evolve in a stable but sustainable way, and making sure things are not moving that fast.
Yeah. It's such a good point. One of the challenges in vaults is it's so clear where they're going long term that people are like want to rush ahead to this end game. But as David mentioned, it's really early. It's daily, liquidity. It's really early, so we have to expect it to take time to expand.
Yeah, I think it is so early, and because it's so early, we are still, um, you know, I talk to hedge funds every day, and I'd say 75% of them have no idea what we're talking about right now. Honestly, I mean, maybe you have a different experience. I mean, I know David and Matt, you do the same, but um, I talk to my hedge fund buddies, and they're like, and I'm like, you should get into some vaults, and they're like, what is that? So I actually want to revise something I said earlier because it made me think of what you just said, Matt. Is although we this is a massive efficiency gain that we will see with vaults, there is also a massive learning curve that has to take place and an auditing process of institutions of this technology that actually probably will be longer than any bilateral negotiated agreement to enter into another traditional fund that any institution goes into any day. Because institutions already have the infrastructure to push new deals in the traditional model out quite efficiently, right? What they don't have is infrastructure to audit a new vault very efficiently. They don't even know where to begin. And they don't even know who to trust in many ways, right? I mean, this is why Bitwise is so important. And obviously Anchorage and Galaxy and a couple others, because, we specialize in focusing on building trust with institutions. But, you say to an institution, don't worry, the vault was audited by OtterSec. And they're like, who the hell is OtterSec? Now, in fairness, OtterSec is one of the most reputable security firms in crypto, but they've never heard of OtterSec. So even if the report is like 10 out of 10 perfectly clean, they still have to underwrite OtterSec now, right? And so there is a big learning curve. There's a lot of infrastructure that needs to take place on the periphery to really unlock this capital.
Yeah, that's absolutely right. And there are questions. Will insurance on vaults become a required prerequisite for most people investing in them, right? When do we get credit ratings across all on-chain challenges? These are infrastructure. You will see growth without these things, but these are infrastructure and decision unlocks that are necessary if we're going to get to work. That's part of the messy middle that I talked about between the immediate opportunity and this $30 trillion is questions like insurance, credit ratings, due diligence, all those things. You have to stack them. That's the stair that gets us from there to the other side, part of the stairs.
Right.
And these are a very real risk, because we've seen very recently with Drift.
Yeah.
And quite a few. It's actually been a bad season for DeFi hacks the past 3 to 6 months.
The drift hack was absolutely scary because of how sophisticated it was. And it was even scarier because it was not an exploit in the traditional sense, right? Typically, what you see is an exploit in which there is a bug in the smart contract code. I've actually been very, very impressed over the last year and a half on how good the smart contracts are now. And you used to see in 2021, 2022, you used to see exploits every day, right? And every day in which a giant protocol got absolutely drained because they didn't some vector was not encoding properly the right order of different operations, right? And it was just an easy mistake to make, and many security firms audited these contracts, but it was still so new. But over time, those exploits hardened the technology against exploits. But now there's a new-ish form of exploit in which there's this social engineering that happens, right? And what happened with Drift is very scary because it almost seems like a nation state actor had a team that met with Drift and built a relationship over many. It reads more like a James Bond spy novel than a typical DeFi exploit, right? So this is the brave new world. I will say one thing though of hope. Tokenized securities actually are going to be a tremendously powerful force against this type of activity. And I'll tell you why. Imagine if the Drift hack actually was hacked and all the tokenized securities got robbed. Well, tokenized securities would just get burned by the issuer immediately and reissued to the proper parties. End of story, no big deal. One of the problems with the Drift hack, and it's been a historical problem for crypto, is that most of the assets that have historically gotten hacked are permissionless assets that by their very nature, there is no central party that can actually rewind the chain, roll back the hack, burn those assets, right? In the Drift hack, there was a USDC opponent, a Circle component that we can get to, but it tokenized securities being issued by a central party, which is what they would have because they are a company's securities, is actually a very nice centralization balance to decentralization, right? These two things working together will actually balance each out in a very healthy way.
That's a fascinating point that will be hard for crypto to wrap its mind around. But I agree with it. I think it's really clever.
People like to push back on that, but the permissionless aspect of crypto means that you're allowed to use this technology however you'd like, and adding layers of centralization within the infrastructure to protect users, I don't think that's a bad thing. I do think that with the Drift hack, I do think, yes, it was sophisticated, but social engineering isn't necessarily new. It's maybe more newer for crypto. I think, Drift shouldn't have had one admin key with all of these resources, with all of these controls. But, and this kind of like leads me to believe like any intermediary, like Kraken released Earn, which you can use Vault products through that. And there's some sense of liability there. And it's going to just push people to these more regulated options because it's 2026 and we still have multi-$100 million hacks going on. And then we want to add, crypto's the frontier and you want to add AI agents managing vaults before everybody else. And Claude just released their new tool. Well, not privately released because of security concerns. So it just feels like it's becoming the industry is maturing, but it seems like it's becoming a little bit wild again in terms of this space.
No, 100%. It's an interesting time for DeFi hacks. Fully agree with Michael. The Drift hack looks a lot like the Bybit hack, right? So it was basically someone had a key that had a lot of control over assets. That key, that secret was compromised, and that's basically where the attack came from. This is very different from the previous attacks we have seen in the past. But the one important thing is Bybit is a centralized exchange. Drift was supposed to be a decentralized exchange. Mm-hmm. And I don't want to be too rough. I think Drift is a great protocol. It's obviously a great team doing great work. But one of the reasons why DeFi should exist and improve on the traditional system is that you kind of avoid single points of failure. And in the Drift situation, we kind of had that. But perhaps the other example I would use that is maybe even more directly related to vaults is actually the Resolve hack. There was Resolve was a different protocol, much smaller hack. I think it was in the tens of millions of dollars range, maybe $20 million. But some of the vault curators had exposure to Resolve, and there were a few issues there. The interesting thing here, and I spoke to some of these vault curators, is that the behavior of the market that we saw during the Resolve hack was that folks were moving from the riskier vaults to the less risky vaults. And I'm saying this because if you compare this to another hack we had, which was the Stream Finance hack, and this was maybe 6 months ago or so, that hack, when that hack happened, what you saw was basically an exodus from vaults. So the market is evolving from seeing these hacks and just getting completely away from the technology to maybe seeing a hack and maybe even seeing some parts suffering a few losses here or there. And instead of completely abandoning the technology, they're just moving to safer or to less risky vault. So I think that's the bright side of these more recent hacks that we saw. The market seems to be more mature in terms of differentiating risks. But I fully agree that the drift hack was scary. And with Mythos, which is the new Anthropic tool that apparently can catch bugs pretty much everywhere to the point that it has not even been released yet, this is definitely a time to stay on your toes as it regards to OPSEC.
Yeah, we thought that quantum was going to be the big risk for breaking cryptography and encryption, but it could be AI could get there first, which is very scary, very scary.
Yeah, or it could still be social engineering,
Right.
getting beers with people.
Right.
The risk.
Different attack vector, but just as scary.
The oldest one in the oldest one in history, getting beers. Yeah. Yeah, I think that that we need to have a better here's the ontology in my mind, the Mark Antonio ontology of decentralization versus centralization. It should go like this. The base layer, whether it's Ethereum, Solana, whatever, should be decentralized. This is going to galvanize and catalyze nations of all different stripes, businesses of all different stripes to build on this decentralized platform. Just like the internet is not owned by any single party, right? But then there should be businesses that are built on this decentralized layer that range in different degrees of centralization to decentralization. Some will be fully permissionless and decentralized. Others will be more centralized. And institutions in that world will have at least a menu of different options to choose from when deciding whether to deposit into a decentralized platform or a centralized platform. And when you have a centralized platform on a decentralized network, what you'll be able to find is that centralized platform will probably be able to get insurance easier. I think one of the big issues for insurers is that how do I insure some decentralized platform? And you will be able to have more of the bells and whistles that institutions are more comfortable with. And if that centralized platform is the conduit to then bridging composability across the decentralized layer with other decentralized platforms, you're going to have, I think that is what you're going to start to see over the next year to 18 months.
Totally agree. Yeah, there are places where it's valuable, places where it's not, and there's everything in between. It's always been a spectrum. It's always been presented as a binary, and a good versus bad. And of course, it's a spectrum and its benefits and risks. And I think the beautiful thing is people will get to choose where they want to be on the intersection of those two things.
I 100% agree with that. I do think that this provision of services can happen on a more decentralized way and on a more decentralized way, and they're complementary with each other. There's one difficult question that the industry will have to grapple through, though, which is where is the dividing line? Like, what are the requirements for you to be a, let's say, curator? And at what point you are just a wrapper and you should register as an RIA? And this applies not only to vaults, right? This applies to, we talked about the security versus commodity distinction for certain crypto assets. I think this is probably the more difficult question that we'll find an answer to. We'll figure that out. We're for now answering the easier questions, but I think this is a big one that we'll have to grapple with, hopefully in the next couple of years.
Yeah. I do see things leaning a little bit more centralized. That tends to be the trend, especially with this institutional adoption. And I agree it's permissionless. So you should be able to build whatever you want and put whatever layers on top of it. I just fear of this future where some young kid is like, I used Uniswap, and the other kid is like, you raw dog Uniswap, you just did that on chain by yourself. And I'm just like, where it's only the super geeky hackers are actually using the proper DeFi native on-chain stuff. Because I want, maybe not the greatest term, but I want DeFi to be the Trojan horse to instead bring the traditional finance industry into this more permissionless nature versus the other way around.
Yeah, I think it's worth mentioning some big news that happened this last week about the SEC pushing for a sort of blanket, not a blanket, but a reasoned exemption for a period of time to experiment in DeFi. And I think that is extremely interesting because rather than come up with all of these different rules on how to police DeFi, sort of have a pilot program, right, in which DeFi institutions and different traders can operate within DeFi in a way that is under the oversight of the SEC, but is not necessarily going to get policed on a day-to-day with certain rules that they're going to have to come up with. So I think it's really a really positive step forward, and I'm really excited about participating in that.
Yep, I think that's right. I would say, Mark, don't worry about it. Decentralization wins at the end. I think of the Jeff Bezos, your margin's my opportunity. It's just getting incrementally better. It doesn't have to go full direct, but that's the direction we're headed.
Thanks. I didn't give you that consolation.
Yeah. Sorry, just to be clear about what I just said about before, like they issued a proposal for a safe harbor, right? And the safe harbor is going to be very interesting for DeFi because right now, for example, just as an example, market makers can't trade tokenized securities on chain because they're securities, and it's just unclear about whether or not, even if they are registered dealers that can trade securities on the NASDAQ, whether they can do those same things on a blockchain. So the safe harbor is going to move very far because one thing we didn't talk about here that I think is relevant is how important the growth of vaults and curation is dependent on a healthy trading environment, high frequency trading environment on chain, right? So one of the big issues, and I get calls about this every week, for RWA vaults specifically, is that they need liquidators. But those liquidators, maybe I should explain this, like maybe I should just break this down for our audience really quickly. Like when when a vault has bad debt, typically how it works is they sell that bad debt to liquidator bots that buy that bad debt at a discount and then swap it into a decentralized exchange. Okay, and this is how the vault or Aave or Compound or Maker will remain solvent, right? But you need the decentralized exchange, or historically you've needed the decentralized exchange components in order to even have the borrow lend protocols. In vaults, similarly, if it's an RWA vault, you need some sort of pool to be able to sell that collateral into to incentivize liquidators. And you don't have that because RWAs are typically not sold on DEXs today because they're securities. And so bridging that is a big issue, right? So the unlock with the safe harbor of being able to potentially trade securities on chain through as a registered dealer you could see a massive explosion on the other side, on the curator side of RWAs.
Yeah, that all makes sense. The thing I would say is this is not only true in the DeFi world, this is also true in the centralized trading world. Like a lot of the crypto trading desks don't have broker-dealer licenses. Most of them don't. So if you want to trade a security, and again, a tokenized security is a security by definition, and according to the recent guidance that the SEC and the CFTC provided, if they are securities, in theory, you need a broker-dealer license to engage with those things. So even in the centralized world, there's a little bit of uncertainty here and a little bit of limited engagement.
Okay, yeah. Nice. Sounds like an open sandbox type of approach, which I'm an advocate of. We're coming up on time there. Any last thoughts on vaults from anybody?
I would just give a party thought here. I do think that the companies today that really invest in the vault technology and invest in figuring out how to build more dynamic vaults with more expressive operations are going to have a market. They're going to capture market share faster and potentially could have a moat in the future. So getting in early, I think getting in right now is I think very important.
I would say wait till Bitwise establishes its moat and then jump into the space would be my recommendation. No, I absolutely agree with that. That's the history of asset management. Early movers in new technologies have benefited from it over time. The other thing I would say to people, I think this has actually been a great conversation, really clarifying on how vaults work, is I say this in DeFi in general. Hands-on experience is a real unlock in learning. That doesn't mean everyone should go experiment with vaults. I'm not suggesting you do that personally, but personally, hands-on experience has been one of the two primary vectors to learn about anything in DeFi. And if you just learn academically, you're missing sort of half of the story. So that's a generalized thought, but I think it's true here too.
I absolutely love that. I think anything related to crypto, if you get your hands dirty, it's probably the easiest way to not only learn but also get excited. Getting an on-chain transaction in is actually very exciting. The one thing I would highlight is we talked a lot about the supply side here, right? Which is what these curators are doing. They're bringing supply to on-chain credit markets. The one thing I'm very curious to see is the demand side. So today we have relatively limited use cases for DeFi credit demand, right? As I said, it's mostly levered kind of buying, to the point that today, because there's not a lot of demand for leverage in DeFi rates are extremely low, and we've talked about this many times. What I'm interested in seeing is, because we're seeing all this supply growing, and it's kind of a given that we're going to see stable coins growing, and a lot of that will make its way into vaults. That's kind of the primary driver here. I'm very interested in seeing what new demands for, or what new use cases for on-chain credit demand we're going to see. Because the rates are now getting probably low enough that maybe we're going to start to see some interesting things popping up.
Yeah, strongly agree. Really great point, David.
Great point.
Love it. Yeah, definitely agree with both points. I'm looking forward to the evolution of vaults. And, for listeners out there, you heard it, get your hands dirty, use this new tech. There's money, there might be some costs along the way and mistakes, but that's the price of this education and this journey. So thanks for listening, everybody, and we'll see you next week.